Nigeria's oil revenue target fell by 125.52 billion in the first quarter of 2020 to 940.91 billion naira, according to figures released yesterday by the Minister of Finance, Zainab Ahmed. The shortfall, according to a report by This Day newspaper, attributed the situation to the double whammy of the headwind caused by the COVID-19 pandemic and the slump in oil price due to a sharp drop in demand and the price war between Russia and Saudi Arabia, representing a 31% of the prorated oil revenue target. Data from the National Bureau of Statistics also showed inflation hitting a two-year high at 12.34%. Besides, the World Bank has projected that based on its assessment of Nigeria's economy, the country will plunge into a recession. But it has proposed a relief package of $1.5 billion to keep the 36 states of the Federation threatened by a fiscal crisis afloat. However, these discouraging figures have come on the back of a more positive assessment by Bloomberg that investors are beginning to revive their interest in Nigerian equities one more time, owing to Nigeria's early move to tap cheap loans, which has improved its risk perception among foreign investors, leading to a fall in the country's borrowing costs. Here with us this morning to analyze all of this is Johnson Chukwu, Chief Executive Officer of Cowry Asset Management Limited. Johnson Chukwu, good morning and welcome to the morning show.
Good morning.
Good morning.
Good morning, and thank you for having me.
Yes, and good to have you here, truly. And thank you for obliging us. Now, quickly, yesterday, Zainab Ahmed, the Minister of Finance, Budget Planning, and all of that, announced that the revenue from oil in 2020 in the first quarter has dropped by about 31%. Now, inflation is up, according to the National Bureau of Statistics, by about 12.34%, which is the highest rate we have seen in the last 2 years. Meanwhile, the poverty rate in the country is about 40.1% of the population. Now, in real terms, what does this mean? And what are the implications in terms of poverty, the country's recovery process from the impact of COVID-19, and also for long-term development?
Okay, Ruben, what I would say is that the figures that the Minister of Finance announced yesterday were figures we were all expecting. I mean, we are all aware that oil price had collapsed, and then that we are not able to sell our current production. So it was expected that the revenue from oil would have come down in the first quarter. The second quarter will actually be worse than the first quarter because you will see in the first 2 months of the second quarter, we've seen figures in April and May, oil price hovering around $22, $25, $29 per barrel. So we should expect a more drastic reduction in oil earnings in the second quarter of this year. You did mention the issue of increase in inflation. Of course, what we're witnessing now is stagflation. Nigeria may be the only country that will witness stagflation. Stagflation is a situation where you're seeing higher increase in inflation, at the same time, lower economic growth or contracted economic growth. These are factors we are driven or caused by the pandemic. We've seen a lockdown in Lagos and other cities in this country. And of course, we know that if you lock down economic activities, if you do not allow people to go out and they're not engaged in economic activities, the level of production in that country will go down. So it's expected that GDP will contract in the second quarter, at the minimum in the second quarter of this year. And like I said, what will be the implication of this to poverty? Of course, if the rate at which your economy is expanding is less than the rate at which your population is increasing, then you're going to see an increase in your level of poverty. The economy has been growing at about 2% in the last 2 years, and population has been growing consistently at about 3% over the past couple of years. So that's why we saw an increase in rate of poverty. You did mention the figures from INDICES are about 41% poverty level. Of course, we know that the Poverty Watch is actually projecting that Nigeria's poverty level is about 98 million people of Nigeria. 98 million Nigerians are living below poverty line. So if you take that against a 200 million population, then you are talking of something close to 48% of 49% of the Nigerian population living below poverty. But the NBS said it's about 41%. So let's even take the NBS figure. The reality is that our economy is not expanding at the rate at which the population is expanding. So we will continue to witness increased level of poverty. But the key thing is for us to look at what has happened, what is happening to oil price, what is happening to demand for food, and then retool our economy and restore economic growth. Well, this economy used to grow at something like 7.5% per annum, year in, year out, for more than 10 years. So it still has the potential to grow at the same rate.
Thank you for this, Mr. Chukwu. Now, I'd like to bring you up on something, because despite our public debts being set to rise to 34.8% of GDP, many investors are still looking at Nigeria as a good place to invest in. Now, this is because the cost of protecting Nigeria's debt against default has dropped by a 520-point basis. Now, creditors are now more willing to loan to Nigeria, and according to the IMF, compared to other sub-Saharan African countries, Nigeria's debt is very much intact, and our officials have done a good job to realign our budgets, etc. How do you react to this?
Okay, when we talk of our debt profile, what matters to me is actually the debt service revenue, which has been on the high. If you look at the debt to GDP, it has remained low. But the challenge you have is that when you use that to measure your debt sustainability, you make a mistake, because you're going to take a debt level that you can't service. So for me as a person, and for anybody who understands critical economic issues, what matters most should be our debt service to GDP to revenue, which currently is above 70%. But back to the issue of why is the economy looking attractive today, you realize that what has happened is that foreign investors were leaving this country because they were worried about the capacity of the country to meet its dollar obligations. So with the soft loans that we have assessed, we already assessed about $3.4 billion from IMF. And then we have about another 3.5 billion in the pipeline from World Bank, 2.5 billion from World Bank, and another 1 billion from African Development Afrasian Bank. So it's expected that if you have, of course, the increase in debt in the first place was a result of the 3.4 billion we assessed from IMF. But the key thing for foreign investors is that they are looking at liquidity. Do you have the foreign currency liquidity that they can leave the country when they want to leave? And if you have access to cheap borrowing that bolsters your foreign reserve, it gives them the assurance that in the short to medium term, they can exist whenever they want to exist. So that's what engendered the new confidence you are seeing that has triggered rallies in the equities market, rallies in bonds, because we've also seen a decline in bond yield as a result of increased demand for Nigerian debt instruments. So because in reality, our liquidity position, our foreign currency liquidity position has improved with the 3.4 billion we've assessed, and the additional 3.5 billion we're expected to come in the next couple of months. So that's what's giving investors the confidence. And again, what you also realize that if you look at some of these Nigerian securities, take for instance the federal government bond. If you look at 2047 and 2049, the yield they were trading at was clearly had factored in a lot of risk premium. So if you de-risk or reduce that risk component, then the pricing will go up and the yield will come down, which is what we've seen. On the equity side, we saw a lot of dumping of Nigerian equities to the point that some of the equities were trading below their intrinsic value. What I mean by intrinsic value is that their actual value, the value associated with the underlying company. So with restoration of some level of confidence in ability of the country to meet foreign currency obligations, foreign investors are more interested in this so that they can actually buy at bargain prices. And that's what we have seen in the last couple of days.
Well, Johnson Chukwu, the Minister of Finance, Budget and National Planning, pointed out that the economy is likely to contract by 8.94%, but that even without stimulus, if the measures that are in place at the moment, if they work, the contraction could be down to just about 4%. And that if additional stimulus is provided, then the contraction may not be more than 0.5%. Is there any basis for that optimism that she tried to put across? And what is your assessment of the fiscal measures that have been initiated so far, and whether or not there is a basis for the confidence that was expressed by Zainab Ahmed yesterday?
Okay. Listen, what I would say as it relates to the basis of optimism is that These economic factors will respond to policies and stimulus. And I have believed that to re-stimulate, to address the economic crisis caused by the pandemic, there are two levels to it. One is the level of sustenance, which is the point where you're giving palliative to households to keep them living and eating for the period they are staying at home. So that's the level of sustenance, which a lot of countries have done, giving out handouts, paying salaries of workers who are not working in Western countries. In the Nigerian case, they have been distributing back supplies to some families, and they also claim they are feeding children at home, school children at home, and they gave some cash handouts. But that's the first phase of it. That's the phase that relates to the period of lockdown. The next phase is to assist companies and businesses that have been badly affected to resume business operations, to resume economic activities. Without that, it will be difficult for the economy to recover. And then the impact of this pandemic will be more severe. I'll give you instances. In other countries, they are already discussing with the airlines to give them some support. We need to also do the same thing here. You need to look at those industries that have run out of liquidity, and then you need to agree on how to support them. I know Central Bank has earmarked about 50 billion for small and medium-scale enterprises. I'm not sure that amount would be material to the needs of that sector, because that sector accounts for more than 40% of our economic activity. And let me tell you what will happen with them. When business activities fully resume, you will realize that a lot of the small business operators no longer have capital to continue their businesses. They need injection of capital. They need some level of intervention from the government. And those are the things that will determine how quickly or whether the optimism of our economy could only contract by 4.4% or even 0.4%. I think the even mentioned 0.4% will be achieved. But if you do not intervene at the firm level, that is the corporate level, and the small and medium-scale enterprises, then recovery will be prolonged, and then consumer demand will collapse, and then it will take a long time, and probably we will stay at the bottom of the economic trough for a longer period. So it all depend on what the government does in terms of really stimulating the economy. And the first phase, we're going beyond that. As the economy opens, the next phase has to come in. What kind of support, economic support, financial support can you give to the most affected businesses? I mentioned the airline business. I mean, their aircraft have been grounded, or commercial flights have been grounded for the past almost 2 months. You expect them to access money to go and do their maintenance before they can start flying. Many of them, some of them have the aircraft on some level of some types of lease. Maybe their lessors have not suspended the lease payments, so they're in arrears of lease payments, and then some of those aircraft may be withdrawn when it's time for them to resume flying. So government has to come in to support. Otherwise, you'll find that the airlines may not go back to the air, and then transportation will be hampered and economic activity will be affected.
Well,
so,
Johnson Chukwu, on that note, let's take a quick commercial break. When we return, the conversation will continue and you'll get the chance to complete your line of thought. We'll be right back. It's still the morning show. Stay with us.
Welcome back to the morning show here on Arise News. Mr. Johnson Chukwu, the CEO of Cowry Assets Management Limited, is still here with us on the program. Thank you for staying with us while we went on a very quick commercial break. Now, you were concluding your thoughts with regards to the last question, and I'd like to pose another one to you to take on as you answer that, because the World Bank, we are also hearing, has a relief package of $1.5 billion for states that's going to be dispersed in September. But many analysts are also saying that we are not seeing state governments and states looking inwards enough in this fight against the current pandemic. What is your take on that, and just how much relief do you think this package can provide? We're being told that states will get between 150 to 200 billion naira each. What is your take?
Okay, just to conclude my thoughts, what I was saying in effect is that the government must be prepared to support the most affected industries and businesses so that they can resume productive activities and continue to employ people. Otherwise, if that is not done, a lot of people will go out of employment, some of these businesses may collapse, and then economic recovery will take a longer period of time. Okay, now back to your question on the 1.5 billion soft loan to the states, to the subnational. I think it will just be a kind of palliative. The reality is that oil prices are not going to recover fully for the next 1 year because currently you have oversupply in the market, economic activities have not resumed fully. The demand for refined petroleum products is going to remain low for quite some time. Vehicles are not going to start moving around. People are not going to start driving around the way they were doing last year. It will take some time for the airlines to resume full load and resume flying at the same rate they were doing last year. So demand for the final product will take some time, which means that oil recovery will take a couple of months. So any intervention or like a palliative of the $1.5 billion will at best be palliative. The state government needs to look at their fiscal structure and look at how do they eliminate what I call discretionary expenses. Are there expenses that the current states are currently carrying that they can afford to minimize? One thing that easily comes to mind is the issue of security votes. Some states spend as much as 500 million to 1 billion naira monthly as security votes. And this is on an unaccounted amount expenditure. I believe the state government can cut down on that. That will free up resources to meet salary payment obligations and meet the basic needs of the state. The first thing at this point is that you have to look at your cost profile and determine what are those cost elements that you can do without. A lot of states are not doing that immediately. I believe that when statutory allocation dropped further, as it did drop in the last allocation that was announced last week, then they will be jarred into wakefulness, and they will begin to think creatively on how to address this problem. The intervention or one-off support from IMF or even the federal government decision to suspend payment of interest, loan repayment by the state in the meantime will not solve the problem, because you're going to see drastic decline in all revenue heads. See tax revenue, like in a state like Lagos that enjoys a lot of tax revenue, or for states it's actually 100% dependent on federation allocation. They're the one that will suffer most. So I think what the state government should do now is to begin to review their cost structure and cost profile and begin to eliminate those costs that they can do without. Otherwise, they won't be able to meet the basic needs of their citizens going forward.
Well, Johnson Chukwu, let's talk about something else. The Monetary Policy Committee of the Central Bank was supposed to meet next week, May 25, May 26, but that has now been moved to May 28 because of the public holidays next week. But what are your expectations? Do you expect or, will recommend that the Monetary Policy Committee should move away from the cautious approach that it's been adopting, given the realities that we're dealing with? Or will you still recommend a cautious approach that the MPC seems to have been following?
Ruben, what I think they should do, given our current economic situation, is to adopt some loosening policies or the loosening approach. The reason is this. What we're going to counter most is that demand or consumption will decline drastically. So we need to make credit available to the to the business operators at lower cost. And one of the policy instruments that the Monetary Policy Committee can tweak with is the cash reserve ratio. At current rate of 7.5%, you are completely taking away all the liquidity from the bank. And you need to restore liquidity in the banking system so that the bank can lend at lower cost or lower rates. That is necessary to stimulate consumption, to stimulate productive activity. The balance that the Central Bank or Monetary Policy Committee have to reach is what should we focus on? Is it managing inflation or controlling inflation or stimulating economic growth? You really can't control both at the same time. If you decide that your priority is inflation management and you want to suck up all the liquidity in the banking system so as to keep rates low, you are going to see a faster contraction in the economic activity. Of course, what is paramount importance globally today is how to stimulate economic growth or economic recovery. So the Central Bank Monetary Committee must recognize that, and they need to allow banks to have more liquidity by reducing the cash reserve ratio. That, for me, is the one that will have immediate transmission into the economy. Issues like monetary policy rates have become almost moribund in the sense that it is no longer a key benchmark in determining the lending rate in the economy. So what would the banks want, and what does the economy want? Inject liquidity in the economy, allow for improved level of lending and at lower cost. And then that probably will moderate the impact of the pandemic on businesses and allow those businesses that are severely attractive of liquidity to resume business operations.
Thank you, Mr. Chukwu. Now, I'd like to take us back to where we started off this morning, speaking about inflation and our current inflation rates, which are the highest that we have seen since April 2018. Now, of course, this is caused by the disruption that we're seeing in supply chains, both locally and internationally. But if I'm to ask for your projections, and this is given, of course, now the easing of the lockdown, the possibility of the reopening of the airspace in June, if we're lucky, the possibility of more interstate travel over the next few weeks and next phases of the reopening, what would you say you project in terms of inflation over the next 2 quarters, or 2 quarters of this year?
Well, we should expect if inflation will continue to inch up, it may not be at the rate it did in April. The simple reason that what we saw in April was, like you rightly pointed out, we had severe supply chain disruption. We also had panic buying of food items. You saw that by the time the federal government mooted the idea of locking down the economy, people were scrambling for food items and therefore bidded beyond. So the demand suddenly skyrocketed beyond the normal demand, and they bidded up the price of food items. And that's why you saw, if you look at the inflation figures and disaggregated, you realize that the highest component was food inflation that actually came at a print of 15.03% in the month of April. If you take out volatile food items, you realize that the core inflation was only 9.98%. So the major driver of inflation in the month of April was high food prices driven by panic buying and supply chain disruption. So I don't think that will be sustained, as you rightly pointed out, when the economy opened up. There will be further ease of movement of goods and services around the country, and that will, to some extent, relieve the economy of that supply chain disruption. But we will continue to see an uptick in inflation, particularly what we call import-induced inflation, because as Naira comes under pressure and we see a depreciation of the currency, we've already seen depreciation at the parallel market rate. Naira is trading close to 470. So you're going to see that price into the prices of goods and services imported into the country, and that will have further lead to uptick in inflation. But I don't think it's going to be drastic, but we should expect in the next couple of months that inflation will continue to each up.
Well, just before we wrap this up, the Senate this week, while debating a motion that have been presented by Senator Gabriel Suswam on the electricity power chain sector and COVID-19, resolved that the federal government should cancel the privatization of the electricity sector, should probe all stakeholders involved in that electricity chain, and then, on the other hand, they recommended that the electricity sector should be involved in the 500 billion naira intervention fund. But their main concern is that all investments in the power sector have not yielded the results. What do you think about this? Do you think government should cancel privatization in the power sector?
Okay, listen, I share with them their view that the investment in the power sector has not yielded much results. But I completely disagree with cancelling the privatization process or the privatization of the power sector. In the first place, the government does not have, and the government never had the capacity to manage the power sector. I mean, under the government, it was not better. We've not seen material improvement in the private sector hands. But there are things which you can do, and then we will address some of these challenges in the power sector. One, we have not adopted the market reflective tariff. So a situation where the cost of generating and transmitting and distributing power is not recovered at the point of sale, then you're dealing with subsidy. You need to address that. You also need to address the issues that relate to what the government should have done, improving the transmission grid. That has not happened. You know, if you load, today we have capacity to produce as much as 7,000 megawatts. But if you load the transmission grid with 7,000 megawatts, you collapse it immediately. So the government has not played its role. Improve the transmission grid so that we can wheel out what we can produce. And then we now deal with the issue of distribution companies. There are a couple of recommendations I've made in the past on how to improve the distribution companies. There's opportunity, government is shareholder in the distribution companies. There's an opportunity for golden shares, where the government can actually seek for new investors, sell golden shares to those investors who have commanding influence on policies as it relates to the distribution companies. And then you compel them to improve their average collection and distribution losses. Average collection, create and distribution losses. If you insist on that and impose sanctions where they default, you'll probably get some improvement. But the problem is that government does not have the moral right. It's owing them bills. It's not addressing the issue of transmission. It's not addressing the issue of multi-year tariff order and cost-reflective tariff. So it's really in a difficult situation to impose sanctions on the distribution companies, and that's where the challenge is. You know, you must go with clean hands. The government does not have clean hands as it relates to the power sector, and the government is clearly unable, because it has no moral authority, to enforce some of the policies that were enunciated in the Power Sector Reform Act.
Well said. Thank you very much, Johnson Chukwu, for joining us this morning on The Morning Show.
Thank you very much.